Just starting the recording. We're going to go ahead and get going. My name is Jeff Gibby. I'm going to be reading the legal disclaimer as per usual. And we have Jay here who's going to be kind of taking it from there. So, everybody, welcome. Thanks for coming today. Good session today. Very much looking forward to it. Let's go ahead and get on to the specifics, shall we? Or the fun part. The demonstration today is designed to instruct you on using MetaStock and the accompanying software plugins. And it's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. Okay, there we go. Let me talk a little bit about our speaker. Jay is somebody that I've been familiar with for quite some time in the market. Undergroundtrader.com is his website. And he's written a couple of best-selling books. I also really I'm very excited about today's presentations. I've had the opportunity to kind of sneak peek and take a look at what we're talking about. And he's going to be talking a lot about kind of using charts in Zenith and how those work and those kind of things, particularly Heikin-Ashi charts, which I'm excited to kind of see. So with that being said, Jay, let's bring you on and make sure everybody can hear you.
Testing. Can you guys hear me?
You're coming through, Jay.
All right.
I'm going to go ahead and basically get out of the way for you and let you talk about it. Welcome today, and we'll let you kind of take over, Jay.
All right. Sounds good. I'll just wait for the screen sharing. Okay. Can everybody see my screen? Okay. And everybody can hear me? All right. Okay. So let's go ahead and get started. First of all, I want to thank everybody for attending, especially during market hours. And it's been a crazy market, and it continues to be crazy right now. We've had some very, very, very precise yet kind of chaotic movement. On the SPY, the 181.51 is actually 181.71 is a 0.50 retrace, and we bounced off that level twice. Not only have we bounced, the buy programs have come in ridiculously. All right, let me turn up my mic. Better? Okay, so let's go ahead and get started here. Jeff spoke a little bit about me. I've been around for over 15 years, and I started off with a site called undergroundtrader.com back in 1998. And the whole purpose of that site was to get to the core of these price movements and how to play them, regardless of what the analyst ratings were, or upgrades, downgrades, any of that stuff that you see on TV. You know, by the time it gets on TV, by the time it makes print, that news is transparent. And once transparency hits, that opportunity is gone. Okay, don't fool yourself. That's the tip of the iceberg. So with undergroundtrader.com and through the journey for the past 15 years, it's been my journey as far as methods and everything has been documented in my books, published from McGraw-Hill to John Wiley, and the latest book is Way of the Trade. And Way of the Trade is a book that focuses on the application, the tactical applications of the methods that I covered in Trading Full Circle, which I thought was going to be my last book. It's like giving birth, and it's a very painful, laborious process. So Way of the Trade, what that does is that takes into account the other factor. You could be on top of your game, you know your methods, and you're a seasoned trader, but there's another factor that's going to make a very material impact on your trading. Right? Now you can adjust, tweak, and whatnot, but the bottom line is the context of the trading environment is going to either make your life a lot easier or it's going to make your life a lot harder. Okay, your skill sets and your knowledge of of your methods, they may not have changed, but based on the environment, trading environment that's out there, it's going to have a material impact on your trading, because what it affects, this market environment, what it truly affects is liquidity. And liquidity overrides price. And that's one thing you always have to keep in mind. And this is very important because I know you all have heard, focus on the trade. Don't look at your blotter. Don't look at the money. Focus on the trade. Okay. And that's something that's easier said than done. Okay. However, that is something that has to ring true. Same with liquidity overrides price. In other words, price is a temporary thing. A price is a temporary label. It's the liquidity behind that price. A stock may be up 75 cents, and there may be enough liquidity if you want to sell 500 shares, but if you're trying to sell 50,000 shares, that price is just a figment of your imagination. You're not going to get filled 50,000 shares, especially if the stock is thin at that price, right? So that's something to keep in mind. Now, I want to tell you right now, get this out of the way. Alpha 7 Trading Academy is sponsoring this webinar along with MetaStock, and our training program has been specifically and exclusively tailored to the MetaStock platform. So if you purchase course levels 2, 3, or 4, okay, you will get a free 1 year free of MetaStock once you open up an account, and then you'll have access to the templates and everything like that. And at the end of the webinar, I'm going to give you some coupon codes where you can use get a special discount on the courses. So stay tuned for the end of the webinar. So once again, purchase levels 2, 3, or 4, and you'll get a year free of MetaStock. All right, so going back to what I was talking about regarding the landscape and the environment, okay, things have changed dramatically, especially with the advent of the algorithm programs and the high-frequency trading programs that are hitting the spotlight. And a lot of what looks like it's something new is really just a repeat of something, history repeating itself. As far as dark pools, well, that's just like Instinet back in the 90s, where only the institutions had access to that. And dark pools existed back in the 90s just as well. As far as the high-frequency trading programs and the algo programs, well, there's always been program trading in the markets. Okay, even back in 2000, there's always been program trading, and the biggest users of high-frequency trading programs are your market makers. All right, the market makers have volume participation programs that are going to come in and kind of nudge the stock prices near that VWAP or away from the VWAP or whatever. Anytime a stock gets an oscillation gets too far out of shape, right? And this is fine. This is what creates the oscillations out there, all right? When it comes to high frequency trading programs, my opinion is very simple. First of all, I know what they are. Okay, they basically extort liquidity, they kidnap it, and they ransom it out at the highest price. That's one side. On the flip side, they also magnify price movements. So if you're in a stock long, and the HFTs come in and they just steal all that liquidity, that stock price is moving very fast, and you can literally name your price. You should be selling, on the ask and peppering it out. So in that sense, HFTs are great. Okay, if you're on the right side, and bottom line is, if you're on the right side of the HFTs, that's great. If you're on the wrong side, it can be painful. So with the advent of all this program trading and everyone talking about speed being co-located on the exchanges, 30 millisecond advantage, dark pools, we have a computerized marketplace. And they say, what, 75% of all the trades out there are electronic trades, okay? And like I said, it is what it is. It's something you just got to work with and make sure you have the right tools and the right training to be able to work with it. It's not something you can sit there and trade all day long. But if you're able to spot the inflection points, the moves, you're pretty much usually guaranteed, to get a move. And with the proper allocation, okay, and timing, you should be able to score money throughout the day, as long as you're not over trading out there. So what that's created, though, is a landscape which I label the Thunder and Tumbleweeds landscape. And that's where you have that big flush of activity, volume, and participants. And then when they thin out or evaporate, okay, you get very thin market conditions. Even your thick stocks get very thin. Bids evaporate really fast, okay? And, in an up market, oftentimes they'll be playing on the short side because there's more liquidity on the short side. When stock is grinding up, it's almost a game of musical chairs. And you got to have the right tools to tell you that, hey, you're chasing here. At this point, you're just chasing, and the tachometer is riding that red line. So you guys, I'm sure you guys have all noticed, how volume can come in, participants can come in and just grind a stock like there's no tomorrow. And then once it peaks, the bids can just evaporate out there. That's your Thunder and Tumbleweeds landscape. And the key word here is participants. When you have more participants, okay, you have more opportunity. It's always about making sure that there's more targets out there other than you. All right. I always say I say that the markets are composed of just carcasses and targets, and make sure you're not either of those. So let's take a look at these participants. If we break them down, we have our institutions. Those are the big money mutual funds, pension funds, hedge funds, private equity, any fund, any institutional, any hedge fund that's got a minimum of $100 million in discretionary capital. Okay, these are the bazookas, the dinosaurs, the tanks. So when they want a position, when they want to move a stock or move a market, it's moving. All right. Algos and HFT programs, these are like the AK-47s, the Gatling guns, the miniguns. They have unlimited firepower, and their advantage is speed. All right. The professionals are the market makers, the specialists. These are, well, they're like snipers because they have order flow information. They are privy to order flow, and they're supposedly looking out for their clients and filling orders. So they have that advantage. And then everyone below that are the retail traders, and they vary. Okay, slow, undercapitalized, undertrained. Their weapons anywhere from spoons, knives, forks, swords, hammers. Okay, let your imagination run wild. Okay, but those are the retail traders. Now, when you get all four of those groups all participating at once, you got what's known as a wet climate. And because you have so many participants, we know that the stock markets are a minus-sum game. So the participants are very, they're looking to jump to the other side if things don't go their way, and vice versa. It's just a back and forth game. Now, they can't maintain that high level of participation all day long. Usually, you're going to have that kind of wet climate in the first 30 to 45 minutes of the day. And then things start to slow down. By the middle of the day, the dead zone period is what I call it. The volume thins out. You may still get action out there. Okay? Lately, we have been having very active dead zone periods. Okay? But generally, the action slows down around 11:30, 12 o'clock, and then you get a whole bunch of chop and flatness for about an hour and a half, 2 hours, and then you get the last 90 minutes of the day, where the volume starts to come back in, But keep in mind, usually, the ranges are so tight by that point that it's like pulling teeth to get much of a move, unless there's something going on with the macro markets, unless there's a big correlation with the SPY because there's so much volatility, which is what we've seen for the last week, right? 70% of a stock's move is going to be linked to the SPY, or the S&P futures, unless there's some type of news, and even then, it's still going to be correlated. Okay, we've been seeing more correlation lately because of the volatility in the SPY, and that's a good thing. Okay, because when you're able to use something as a benchmark, then it allows you to measure whether your stock is buy fading or sell fading. And if you have that insight, okay, that's what's going to give you the heads up to be able to step in before the action hits. So through the years, what I've developed is a tool called the rifle chart, and this tool allows you to visually see the trend, visually see the trading range, and visually depict visually see if a stock is overbought or oversold. Okay, and that's the general explanation of the rifle chart. And with the rifle chart, it's composed of very simple, almost household items when it comes to platforms. And on MetaStock platform, which is what I'll be going over the rifle charts on today, all the tools are right there. Okay? An abundance of tools, actually. So this is your basic rifle chart, composed of your 5 and 15 period simple moving averages. So 5 in yellow up here, 15 in green, and then we have our Bollinger Bands, your upper, lower, and middle. Middle Bollinger Band also acts as a 20 period moving average. And then your stochastics on the second portion of the chart. The yellow is elite stochastic, the green is the laggard stochastic. And then with the Bollinger Bands, we can see the compression right before the expansion, which tells you that the price range is looking to expand. And then you get the compression, where the range starts to tighten, and then another expansion. Now, to set up your rifle charts on MetaStock, you will have to basically pull up your simple moving averages and add a 5 and a 15 period moving average for your stochastics, 15, 3, and 3. For your Bollinger Bands, 20 and 2 standard deviations. And then what's optional are the 50 period and the 200 period simple moving averages, along with volume bars and pivot points. Excuse me. All right. And this is what your rifle charts look like on your setup, 15, 3, 3, on your stochastics, that is. Stochastics is what tends to throw most people off. All right, so now once you set up the rifle charts, what we have here is what I call a pup pattern. And this is where you get a breakout, a price expansion, a peak, and an exhaustion, or a reversion, and the moving average, 5 period moving average, instead of crossing down, starts to go sideways. All right, and that's just because neither side is really pushing. Yeah, you're going to get sellers come in and some bears try to short, but you also have buyers that are pretty much keeping this thing afloat. So by chopping above and below that 5 period moving average, what tends to happen is the moving average starts to go flat. But the 15 period continues to rise. Now, as 15 period rises, what happens is this trading channel starts to get tighter and tighter. And therefore, the risk, if you take along the risk, actually becomes less and less because it's got less of a distance to fall. And eventually, when the buyers, or most importantly, the shorts, start to get real nervous, they start to cover when the stochastics cross back up. When the stochastics crosses back up, Then what happens is the bears start to cover, the buyers start to come in off the fence, and then boom, you have the next leg of your breakout. And this is called a pup breakout because the uptrend, technically, the uptrend is still intact. It's just not an active uptrend making new highs because you have profit takers and short sellers that come in and flatten out that 5 period. And what they're anticipating is the 5 period to cross down through the 15 period while the stochastics crosses down and continues to oscillate down. That's the best case scenario for the bears. For the bulls, they want to suck in the bears a little bit and then get that cross and break out next leg up. And that's called a pup breakout. Turn this upside down and you have what's known as an inverse pup breakdown. Now, a mini pup is the same thing, but it happens on the stochastics. So with the mini pups, keep in mind that when a stock oscillates up or moves up, the stochastics also move up. Okay, when a stock moves down, stochastics should pretty much follow back down. If that is your cookie cutter movement with your stock price and your stochastics. Now we all know that that stocks rarely continue to go up in one fell swoop, and usually when they do, it's very hard to catch that. So when you get a spike and then a reversion, okay, so in other words, you get that green candle spike, then you get the reversion, a counter candle, okay. What these guys are doing is basically they're coming in and they're shorting this thing, hoping that the stochastics are going to peak at that 80 band and cross and come back down, just like it does right here. And by coming in and taking Facebook back down, what they've done is they've created a counter candle. They basically left their footprints. And so the rule of a mini pup is that you get the stall on the lead stochastic, and it looks just like it's going to cross back down, but it doesn't. It doesn't cross back down. It stalls simply because the price is not moving higher, but it's actually in a reversion and pulling back. Now, we utilize the moving averages because that 5 period moving average acts as a support. So when they hold that 5 period moving average and deflect it back up, when they break the body high of that counter candle, it triggers the squeeze, because anyone who's shorted here gets they get optimistic when it comes down here. They get nervous, and then you get the shorts that start to cover. And nobody here is profitable at this point. Shorts cover, buyers coming off the fence, and then the stochastic stalls and then slopes up. And so you never get a cross down, you get a stall and then a head fake and a slope up. And that's what creates what I call a mini pup. When that mini pup forms, okay, you're going to get a squeeze and a grind. Now, the one indicator you always want to watch is that 5 period moving average. It's the 5 period moving average that acts as your support. Okay, and then the mini pup, you have a counter candle, and then another mini pup, and you get a nice flush all the way up here. Okay, and thus your high band mini pup. When you get a high band mini pup, it's oftentimes a climactic pop. Okay, and that's where you want to sell into. Now, when you get a new high, a higher high, and a lower high, okay, that's called a market structure high. And I like to use intraday highs and lows. So intraday, a new high, okay, talking about the candle close, and then a higher high, and then a lower high. And on that third bar, the third candle, it's a 3-candle sequence. The low of that third candle, the full candle low, I'm talking including the shadow or the tail, that break becomes the trigger for a market structure high. So when you get a market structure high, oftentimes you can short one tick below the low of that. Okay. Oftentimes the market structure high is going to coincide with that 5 period moving average. 90% of times you're going to get that 5 period moving average literally act as a trigger. Now, to up your probabilities, you also want to make sure you have the stochastics that slip through that 80 band. Notice the initial trigger, they tried to bounce it, they couldn't, It bumps heads with the 5-period moving average, can't close above the low, and then it just wilts down, and basically this is a mini inverse pup. Anytime you get a counter candle that gets taken out, it's a mini inverse pup, and then you get that nice oscillation right back down. Okay, so there's your rifle chart pattern of the mini pup, and then you invert that, and that's your mini inverse pup. Now I know a lot of this stuff may go right over your heads, okay, and that's fine, because bottom line here is all I want to do is just show you something that may be different to what you're using, all right? Tweak your interest, and if you want to fill gaps in your trading, or if this is something you want to learn fully from the ground up, okay, then we have our trading courses here for you. All right, and this is your perfect storm pattern, and what I do with that is I look for the mini pups or the pups, okay, on 3 or more simultaneous time frames. So utilizing the 1, 5, 15, 60, and the daily intraday, and then the weekly, monthly. For the intraday, you want to use those 4 time frames specifically. Okay. What we end up seeing is something like this: a 60-minute mini pup that forms the anchor, 15-minute consolidation, okay, and then a pup breakout that tries to form, 5-minute, very flat, very tight compressed 5-minute Bollinger Bands. Get the mini pup that breaks through, triggers, and look at that. You get the spike, pullback, counter candle break, and then 5-period starts to peel back up. Okay, and that's your mini pup. Your long trigger, bam, right there. And then your 1 minute is going to always be, well, the 1 minute's always going to be the trigger or the fuse that will light and awaken the other time frames. And the larger time frames carry the most distance, the most follow through. Okay, but they can't trigger, they can't detonate until the shorter time frames also shorter time frames detonate. All right, so what I have here now is a video I want to share with you that I made of First Solar and a pup breakout on the MetaStock platform. So if we take a look at First Solar here, all right, first of all, this is your 1 minute rifle chart, 5, 15, and 60 minute, and then excuse me, you have the SPY, 1 minute and 5 minute. So those are our benchmarks. So First Solar, okay, is forming a test for a second perfect storm breakout. Now, right now, First Solar is trading at 55.66. I want you to take a look at this 5-minute chart here. This is what's known as a pup breakout. So you got the initial spike, the pullback, 5-period moving average slopes, flat, flat, flat. 15-period continues to come in, tightening trading channel, okay? And then you get the counter candle break, also coupled with a 5-minute mini pup. Boom. And it's on this break through that 54.60 area that the 5-minute has formed a pup breakout. Now, what's going to give you a heads up that this thing is going to form a pup rather than a breakdown? Well, you look over and you look at the 15-minute chart and you notice it already has a 15-minute mini pup, and then you're also in the midst of a 60-minute pup breakout. It's like a Doppler radar effect. Okay. Now, I also teach about the stinky fives level, so that's going to be that 54.50 add minus 10 cents. Okay, so 54.50, 40.60 stinky fives area. That's where it's got to climb out of, right, to start to get the next move. And then up here, 55.50 add plus minus 10 cents, and that's going to give you 55.60, 50, and 40 as your stinky fives levels on the 55 level. So we've already formed a pup breakout, okay, and a perfect storm on the 54.60 breakout. Now we're watching as the 55.60 breakout, okay, is trying to form another perfect storm. We'll notice on the 1 minute chart, notice that the 1 minute's starting to go flat here, flat, flat, flat. 5 minute is in a pup breakout still here, okay, because you have your rising 5 period and 15 period. Now, you may say that, well, the 1 minute, the stochastics looks like it's peaked out. Okay, keep something in mind. Above that 80 band, stochastics it's okay for it to peak out. Because if you're a bull, all you're trying to do is defend this 80 band. So anytime the stochastic starts to come down to that 80 band, the bears get all anxious and they start to come in and try to push it down. If you're a bull, you only have to exert effort at that 80 band. And notice what happens anytime it coils off the 80 band, just like it did here. Okay? It forces a squeeze, and the shorts get squeezed higher. Now you got your 1 minute starting to cross back up here. And as a 1 minute crosses up, all that's going to do is continue to grind the five minute chart. Notice we have a counter candle right here. Okay, right around that 55.68, 55.69 area. And so when the 1 minute crosses up, you're going to get the 5 minute that crosses back up, counter candle break, squeeze. Is there any reprieve for the bears in the 15 or the 60 minute chart? No, because the 15 is still in a pup breakout. What about the SPY? Look at the SPY. You notice the 1 minute on the SPY is actually thrusting here, okay, with a 1 minute mini pup. 5 minutes, which is known as a make or break, meaning the 5 minute has a mini inverse pup, stochastics down. But notice the 5 period moving average. It's flat, right? And on a flat 5 period moving average, what's going to happen when the stochastics cross back up? It's going to form a 5 minute pup breakout. Now, watching this first solar, and notice the green candle, okay, it held the 5, it closed just above the counter candle area, but you're not seeing much force here. You're not seeing a lot of pushing here. And the one thing you want to kind of keep in mind is if you don't have action, all right, if they don't, squeeze the sucker back up immediately, always watch the clock, okay? Always watch the clock. Look at this. It's 11:57 right now, all right? And understand when I say watch the clock, I'm referring to the actual clock. And, oh, not what I just do. Sorry about that. Come on, guys. Look at it. All right, so when I say watch the clock, okay, I'm actually saying watch the clock because every 5 minutes you're going to get a 5 minute candle close, right? Every 15 minutes you get a 15, and so forth. And every 1 minute naturally you get a 1 minute candle close. But on the 5 minute, if the 5 minute has a pup breakout, what we're watching is for that 5 minute candle to close. And then when that happens, it's going to lift the 5 period moving average higher. And when that happens, what the bulls or the bears start to get nervous and start to cover. So now we see the 5 minutes. 5 minute just took a jump here. Here's a 1 minute cross up. And notice I was chopping around 55.68 to 55.60, right? Now we have the counter candle break here. At the counter candle break, we have the 1 minute that's now crossed up, and the 15 and the 60 are still in a continuous uptrend, right, in a pup breakout uptrend. So at this point, okay, the long trigger was right around that 55.70 area. Okay. Now another thing I want you to keep in mind that I put on here is think like a bear. All right. Whenever I know this is a little hard for you guys to do sometimes, but think like a bear in that in the eyes of the bears. Okay, when First Solar made the initial peak and put in that counter candle, that red counter candle, okay, well, what is this? This is a potential, what, guys? A market structure high, right? New high, higher high, lower high. And the low of that candle break, okay, would trigger a market structure high if the stochastic crosses down. That's the thing you got to keep in mind. When you have the rifle charts, that helps to keep things a little more clear. Whereas anyone who plays like pure price action, they may just go by the candles and jump in and try to short and then end up getting squeezed. Now, on the rules for a market structure high is you short the low, one tick below the low of that counter candle, the the third candle of the 3-candle series, and then you trail one tick, a trail stop one tick above the high of that market structure high candle. Okay, so since 53.54 is the low of that red candle, we would need 53.53 to break for a market structure high to consider taking a short. Notice now that we're trading above there, but we also just broke the high. So your stop is going to be the high of the, well, pretty much the high of the day. All right, so now that's triggering the stop, and that sucks in the, well, that sucks in the shorts to start the cover. You see that? Okay, 5 minute now crosses up because we just got the close. Well, 2 minutes ago we got the 210 close. The 1 minute forms a mini pup, and now we have all 4 lanes to the upside, and you can see how First Solar is starting to jump here. Now here's the other thing to keep in mind. The SPY was actually selling down. All right? Remember, the benefit, the use of having a benchmark is that it tells you how well your stock is trading. Number one. Number two, you would be going, number two, okay, when the benchmark, the headwinds bounces, what do you think is going to happen to a stock that's buy fading? Right? It's going to spike harder. Okay? Oh, as far as where you would take the long, is when you get that 1 minute cross and a break through that counter candle. Okay, so the 55.70 is the long trigger, 55.70, 55.71. Take the long, all right? And as far as this thing buy fading, or this thing buy fading the SPY, now the SPY is trying to make a bounce here. All the SPY needs is a 20 band cross up. You'll see that the market structure low. The market structure low is right above the 1 minute 5. Okay, you have the 1 minute mini pup that's trying to make a thrust here. But the 5 minute is forming a, well, it's got a pup breakout. Okay, trading at 55.85, 55.86. Now, as the 1 minute crosses up through the 20 band, and as the SPY starts to lift, anything that's been buy fading is going to get more buying pressure. See that? 55.89. And look at that beautiful slope up. 1 minute mini pup. 5 minutes got a pup breakout. Okay, 55.90. And now, keep in mind that the upper Bollinger Band's updated on the 60 minute and then the 15 minute upper Bollinger Bands on the charts. All right, we always got to keep an eye on that SPY because SPY made its bounce, made a coil, and it's nearing the 1 minute 50. So you always got to keep an eye on your benchmark index as well, okay? Because when the SPY peaks, there's a good chance First Solar is going to see some sellers coming in and start to peak as well. So First Solar is continuing to grind. When you get that 1 minute forming a high band mini pup, okay, that's when you can expect some climactic action, a spike. 56.15 is your 5 minute upper Bollinger Bands, okay, and so we always take into account the 10-cent overshoot. So the 56.08, 56.15, okay. Those are levels that you want to keep an eye out for on spikes. When they spike through that round number, okay, you want to have orders in there or sprinkled in there to be able to sell into those pops. And then the SPY is still making that 1 minute oscillation. And what the SPY's got to do here, though, it's got to break through 5 period moving average, because this is what looms on the SPY. Okay, you still have resistance here on the SPY. It's what's known as a make or break. So either we are going to get the 5 minute cross up and form a pup breakout on the SPY. If that happens, okay, that's going to be even stronger for First Solar, which has been buy fading, right? Or it's going to stall, reject, and form a mini inverse pup, right? Where it's going to lean back down. Okay, so and now with the 1 minute, 1 minute's already peaked. Okay, at the 50 period moving average. Notice the 5 period moving average is sloping up. If it tests and coils, then it forms a 1 minute mini pup towards that 80 band. And it's going to be on the coil and the pop and the thrust where you want to be peppering shares out. So as we can see, this thing is still in a perfect storm breakout. 1 minute's very lofty here, okay? But once again, as long as they hold it above the 80 band, not a problem. Now, talking about market structure high triggers, can this form a market structure high? Of course. New high, higher high, lower high. Now, if they break that lower high and get the stochastic slip through that 80 band, that'll seal a 1 minute market structure high. However, note the 1 minute 5-period moving average. Okay, it updated, it just caught it. So now we're either going to get a push through the low of the candle or through the body high, which would then trigger a mini pup spike. Then we look at the SPY, and SPY, the 1 minute is in a make or break situation here. 5 minutes still a make or break. Even though you see a mini inverse pup here, you got to always watch the moving averages. Anytime those moving averages get flat, okay, or they get tight and they're overlapping over each other, all right, you want to be very careful because it could go either way. So as the 1 minute starts to stall out and peak, okay, we're watching the 1 minute counter candle here. And one of the nice things, I guess, about a 1 minute chart is that it updates every minute, right? So we get another candle update. Now here's the best part. Even if the 1 minute candle slips, the 5 minute stochastics is already crossed up. It's crossed up. What would be very nice is if that 1 minute slip and it pulled back to that 5 minute 5-period moving average, okay, even overshoot a little bit, and then squeeze back up on a 1 minute cross up. That would form a mini pup on the 1 minute chart. Okay, that's beautiful. So oftentimes when you get the cross up, it'll make an initial pop and then pull back. You want that pullback. Number one, first of all, if you didn't take it long, it gives you an opportunity to step in, number one. But number two, okay, it reinforces, it galvanizes that 5-period moving average support because it tests it. Okay, there's a big difference between predicting a price level and having a price level test and deflect off. And that's the whole basis of mini pups. The market tests it. They're going to pull it back. They pull it back. They test that 5, just like it did here. They test that 5-period moving average. They try to push it down. They hold the bulls hold it up long enough for the candle to update, pull up the 5-period, cross up the stochastics, and the next thing you know, you got bears that get squeezed. The bears get squeezed, okay, and the stock resumes its uptrend. Now, right now, we're still holding that 1 minute 5 here. 5 minute, once again, they can pull back to 55.77. We welcome a pullback to 55.77. Okay? Overshoot it, hell. Overshoot it, suck in the bears, and before that 5 minute candle closes, as long as they coil it back up with the help of the 1 minute stochastics cross up, that's going to form a mini pup, and then that's going to seal the price move now to the upper Bollinger Bands, because that's what acts as a target whenever you get a mini pup. And we see that 56 has been pretty stubborn, okay? That 56 has been pretty stubborn, but this is a nice slow grind. 1 minute 5 continues to stall, and this is very resilient, very resilient. And the 5's going sideways, and if we get a stochastics cross up, this thing forms a pup breakout and squeezes to the upside. Now, take a look at the 1 minute on the SPY. It actually stalled and formed a mini pup, and the SPY is pushing up. And look at for solar. There's a squeeze. Bam. You see that? Look at that pop. Bam. Squeeze. Squeeze. Okay. And we never even tested those 80 bands. So the shorts that came in here, based on a market structure high attempt, trying to get in early on the trigger, they got grinded, and squeezed. They tried to do the same thing right here. Market structure high attempt, new high, higher high, lower high. They did push it down initially, okay, but then the pup formed and they squeezed them out again over here. Okay? And the reason why this happens is you look at the 15 and the 60, and you can see they have the 60-minute pup and the 15-minute mini pup. So they were already predestined, almost like, fate, that this thing's going to explode. The wild card is always going to be your SPY, okay? And if that SPY actually does collapse, then the perfect storms will start to fade. But the beauty about perfect storms is that even if the SPY does a face plant, you have supports at the 1 minute 5, the 5 minute 5, and the 15 minute 5, okay? And sometimes even the 60 minute 5. All right, you don't want to get too far down on the ugly tree. But you have 3 layers of any chart that's got a pup or a mini pup, that 5-period moving average has been tested and is a support area where it can bounce, it can coil, okay? So that's how perfect storms give you protection. That's a great thing. They're very strong. Now, I'll tell you what's even better than perfect storm, okay, is a perfect storm failure or a reversal of a perfect storm. Naturally, if something's very, very strong and it gets taken out, what does that tell you about the other side of that trade? Okay, if a perfect storm breakout gets muscled down and sulfates against the backdrop of, say, the SPY or the SPQ, the SPOOs forming a perfect storm breakout, what does that tell you? It tells you that there's a lot of sellers, because in reality, someone's got a lot to sell. Because the reality is, why would I want to give away shares at this price when I know that if I step off that ask, the stock's going to pop? Why? Because I got so many shares, right? And to me, price doesn't matter. If I'm a fund, price doesn't matter. Why? Because liquidity overrides price. I'll get more liquidity selling into this here while the SPY's up, as opposed to stepping off and letting First Solar try to ramp as much as it can and then come in and start dumping, okay? And that tells you something. It tells you that the other side is twice as strong. And if it's twice as strong, then you want to watch and look to jump to the other side. And anyway, this is what your First Solar perfect storm breakout looks like. Now you have your 1 minute mini pup grind, 5 minute continues to grind, 15 minute, well, 5 minute pup, 15 minute mini pup, and a 60 minute pup breakout. Okay, so the perfect storm breakout triggers a nice move from that 55.68, 55.71 trigger, okay, up all the way towards the 56.41 area. All right. Now I'm not saying this is something that where you would take the whole price move. Okay, if you're a scalper, all right, you can take heavier size and scale out into that move. And as you approach those upper Bollinger Bands, you're scaling out into it. Okay, and it's not even so much of, well, how much of that point gain move did you make? The reality is your money, your real money, the real money in this game comes from size. When you have a perfect storm and that 1 minute's got a favorable trigger, you take more size. You take more size and you scale it out. And that's the risk and probability dance. All right, so going back to the slideshow. All right, so this is what the perfect storm looked like. I'm going to go ahead and just review the perfect storm real quick. All right. There's your long trigger on the counter candle break. And that's because, once again, the market structure high failed. Okay. And those of you who do take the training, you're going to look at market structure highs. Market structure highs are great ways to short and make quick money, okay? Unless they fail. And you're going to sit through, you're going to jump on market structure highs that form, and you stick around too long. You don't take the stop, okay? And that's how you're going to learn. That's how you're going to learn. This is how you're able to think like a bear when you take longs. Okay, because who better knows how strong a stock is than someone who's short, right? Okay, and once you understand that, and once you can kind of step back at a distance and kind of feel that out, it's going to make you a better trader. And when it comes to trading, there are 4 stages of trader evolution. The acclimation stage, that's where you're just starting off, learning the basics, the building blocks, the mechanics, the structure of everything. The price moves. What makes a stock price move? What's the connection between all these pieces? And having it all come together, basically, to paint the picture. Stage 2 conditioning is where you apply the methods, the building blocks, see everything work in this, and there's synergy, okay, to be able to get in and get out, find the liquidity, etc. Stage 3 is your seasoning. That's where you are very familiar at this point because you have gone through the conditioning and the repetition, and the repetition, right? And then the specialization stage where you're literally, you focus on a handful of stocks, right? And you're literally like a specialist or a market maker. These 4 levels, these 4 stages of evolution, that's not something that's done overnight. Okay, something that you can do on your own. Could take a decade, right? Or you could look for a specialized training course with that in mind. And this evolution, your evolution, can be cultivated with the proper training. And this training should encompass everything I just said, basically. All right, and so this is where we come to the Alpha 7 Trading Academy trader training program. We've got over 30 hours of videos, over 600 slides. Everything has been meticulously created, designed, and structured in a lateral, progressive, and depth engaging approach to organically cultivate your evolution towards becoming a seasoned trader. And we've also customized it for the MetaStock platform. Okay, so this is one of those few cases where we went out of our way to convert the training program so that it works on MetaStock with all the examples and videos on the MetaStock platform. And these are the coupon codes for those of you who have had the patience to stick around, even as the market is grinding. This is your little reward. Okay, for a limited time, if you use the coupon code META10MET, get 10% off purchase of level 1. Okay, now for level 2, 3, and 4, use the coupon code META20MET for your free 1-year MetaStock subscription. Okay, and those are the coupon codes, and that is our training. All right, everyone. I'm gonna turn it back over to Kelly or Jeffrey. Jeffrey.
Yeah, either one.
And I'll thank you guys for coming out, and I wish you guys best luck with your training and trading. Thank you, everyone.
All right. Thanks, Jay. We really appreciate that. And then just so you're totally aware of it, if you do the level 1 training, you're going to get 10% off. But if you do any of the higher levels, they're actually going to pay for MetaStock for you for a year. So we're pretty excited about that. If you're looking for training and you like what you saw, I'd recommend you take a closer look at this. Anyway, thanks, Jay. We appreciate your time today. Really good to have you. And we'll see everybody at the next webinar. Thanks, guys.